One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. This is Investment Banking Insights, the show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason. I am your host, and I am so grateful that you are here joining me today. And we are just running through these technical questions, understanding all the ins and outs of accounting fundamentals. And today's episode is no different. We have another accounting topic for you today. Walk me through a $100 equity bailout of a company. That is today's question. And in order to answer that question, we have to first know, well, what is a bailout? What is this thing called a bailout? I mean, we may have heard this on the news for various companies over the years, but what does it really mean? A bailout is when a company is saved from insolvency, also known as bankruptcy, going bankrupt. And it is saved by a third party, usually a government, who injects cash into the business to keep it alive. And there are two forms that this cash can take, just as there are two forms any investment in a company can take. It can either come in the form of equity or it can come in the form of debt. So equity is buying shares of the company and debt is lending the company money and having it pay you interest. And so here the question is specifically focused on talking about an equity bailout. So we can assume that this third party, for example, a government, is exchanging cash for equity in the business. So how are the three financial statements affected by this $100 equity bailout? Let's go ahead and walk through them. And as always, we start with the income statement. Well, there was nothing sold here, and there was nothing like interest expense or a gain on the sale of a property or any of those kinds of things. So the income statement is actually not affected here with this bailout. So we can go ahead and just kind of move on from that to the cash flow statement. On the cash flow statement, let's look at the three sections. At the top, we have operating cash flow. Well, the company is being bailed out and there's nothing changing to the operating financials of the company. So nothing is changing there. Moving on to the next section of the cash flow statement, we have investing cash flow. The company hasn't purchased any equipment. It didn't sell any land or property or anything like that. So investing cash flow is also not affected. But let's take a look now at the third part of the cash flow statement, the financing cash flow statement. This is affected because money was just raised. And in this case, it happened in the form of equity. So you would see a cash inflow recorded in the financing cash flow section of $100, positive $100. And then if you add up all those three sections, zero change plus zero change plus $100 equals a net $100 increase in cash to the company as your overall effect of the bailout. So that's the cash flow statement. Let's go ahead now to the third financial statement, which is the balance sheet. Now, cash has increased because of this bailout, this equity bailout. So on the asset side of the balance sheet, our cash line item is going to be increased by $100. And that's all we have on the asset side. Moving over to the liability side, the company hasn't raised any debt, it's raised equity. So remember, debt is a liability, no change to the liability section in this case. So how does this balance sheet balance? Well, we have to look at the last section, which is the shareholders' equity section for the answer. Since the company was bailed out via equity, new shares were created in the process. And so shareholders' equity increases by the corresponding amount of the cash infusion. So in this case, shareholders' equity increases by $100. Now, note, we are so used to at this point just bringing over the net income from the income statement and saying, yeah, that's a change in shareholders' equity. This is not one of those cases. There were no changes to net income because the income statement wasn't affected. However, shareholders' equity still increased because there are multiple components of shareholders' equity, and there was additional capital paid into the business to create these shares of stock. And so that's why shareholders' equity is increasing here by $100. And that balances with the increase in cash that the company receives from the bailout on the asset side of the balance sheet of $100. So the balance sheet balances that way. And that's what happened. So that's how a $100 equity bailout of a company affects the three financial statements. Kind of a fun scenario, at least for me, kind of fun to think through, like, how does this actually affect things? And yeah, that is it. So thank you for listening to Investment Banking Insights. And next time, we're going to be talking about why a company would collect cash and not record it as revenue. I kind of like these conceptual questions. So we're going to be moving on with accounting next. And I'll see you. Have a great day.